Welcome back to the Bitcoin Street Journal podcast. I am your host, Anna, coming to you from the intersection of signal and sovereignty, where blocks are final, incentives are honest, and the fiat narrative continues to unravel in real time. If you are new here, this is not a hype show. This is not a trading desk. This is a journal of record for the Bitcoin era. We slow things down, zoom out, and connect the dots so you can understand not just what is happening, but why it matters. Before we dive in, a reminder. If you want to discuss anything we cover today, go deeper on the data, or engage directly with the community, head to thebitcoinstreetjournal.com and use the link at the top of the page to log in or sign up on Nostr. That is where the real conversation lives. Zaps are votes, replies are peer review. Now let us begin. Bitcoin price and market context. At the time of recording, Bitcoin is trading just under $90,000 per coin. Dominance remains elevated, hovering above 60%. That matters. It tells us that in moments of uncertainty, capital still consolidates around the most secure, most liquid, and most battle-tested asset in the entire crypto ecosystem. Zooming out, this price action is not unusual. Post-halving years have historically been volatile, choppy, and psychologically exhausting for participants. The market shakes out leverage, tests conviction, and punishes impatience before resuming its long-term trajectory. We are seeing that playbook again. On-chain data shows long-term holders adding Bitcoin, not distributing it. Exchange balances remain near multi-year lows. Meanwhile, short-term holders continue to react emotionally to macro headlines, interest rate noise, and regulatory theater. This is the divide. The people who understand what Bitcoin is are accumulating. The people who think Bitcoin is a trade are getting shaken out. Halving reality check. We are now fully living in the post-2024 halving environment. Block rewards are down to 3.125 Bitcoin per block. That is it. There is no emergency issuance lever. There is no committee vote. There is no bailout. Every 10 minutes, less Bitcoin is created than at any point in history. That supply reality is colliding with rising institutional demand, nation-state curiosity, and growing retail awareness. This is not a matter of if that tension resolves upward. It is a matter of when and how violently. Institutional accumulation is not slowing. One of the most important signals this week is not price, it is behavior. Strategy, formerly MicroStrategy, continues to accumulate Bitcoin at a pace that would have been unthinkable just a few years ago. In the past several weeks alone, the company has added billions of dollars worth of Bitcoin to its balance sheet. Regardless of your opinion on Michael Saylor, the message is clear. Public companies are no longer debating whether Bitcoin belongs on a balance sheet. They are debating how much exposure is enough. We're also seeing this behavior ripple outward. Smaller public firms are adopting Bitcoin treasury strategies. Mining companies are holding more of their production. Financial institutions are exploring Bitcoin-backed lending and collateralization. This is not speculation. This is balance sheet engineering in a world where fiat liabilities grow faster than productive assets. Advisor adoption is quietly exploding. One of the least discussed but most important developments right now is the role of financial advisors. Recent surveys show that roughly 1/3 of professional financial advisors are now allocating or recommending crypto assets to clients, with Bitcoin making up the overwhelming majority of those allocations. This matters because advisors control trillions of dollars. They move slowly. They are conservative by design. When they move in size. This is not retail chasing candles. This is structural adoption happening behind the scenes. Government and sovereign signals. The United States government now holds a meaningful amount of Bitcoin, largely through seizures and enforcement actions. But the conversation has shifted. Bitcoin is no longer just something the government confiscates. It is something policymakers are actively discussing as a strategic asset. We are seeing executive orders, legislative proposals, and public debate around the idea of a strategic Bitcoin reserve. Whether or not those proposals materialize immediately, the Overton window has moved. Bitcoin is now part of the geopolitical conversation. Internationally, this trend is even more pronounced. Emerging markets continue to experiment with Bitcoin for remittances, savings, and settlement. Energy-rich nations are exploring mining as a way to monetize stranded resources. Financial hubs are competing to become crypto-friendly jurisdictions. This is the early stage of monetary competition playing out in slow motion. Regulatory noise versus reality. Yes, there is still regulatory uncertainty. Yes, there are still delays, enforcement actions, and political theater. But here's the truth. Regulation follows adoption. It does not lead it. Bitcoin has survived outright bans, hostile regulators, coordinated media attacks, and internal civil wars. It is still here, stronger, more decentralized, and more widely held than ever. Meanwhile, the regulatory posture toward proof of stake, stablecoins, and centralized intermediaries remains far more complex and fragile. That distinction matters. Bitcoin is not asking for permission. It never did. Quantum fears and long-term security. You may have seen headlines about quantum computing posing a theoretical risk to cryptography. These discussions are not new. They resurface every few years. Here is the grounded reality. Bitcoin is not static. It is a living protocol with an active development community. If credible quantum threats emerge, Bitcoin can and will adapt. The more immediate risk is not quantum computers. It is poor custody practices, centralized points of failure, and user complacency. Which brings us to today's educational segment, Educational Bitcoin Tip of the Week. Understand your wallet, not the interface, not the logo, the actual mechanics. A Bitcoin wallet does not store coins. It stores keys. Whoever controls the private keys controls the Bitcoin. If you're using a wallet where you cannot independently verify, back up, and control those keys, you're trusting someone else with your sovereignty. Beginners should start by learning the difference between custodial and non-custodial wallets. Pros should be thinking about multi-signature setups, inheritance planning, and geographic redundancy. On Nostr, there are active communities discussing wallet best practices, custody models, and real-world lessons learned. Log in through the bitcoinstreetjournal.com and join those conversations. Ask questions, share experiences, zap good information. Nostr is not optional. A quick word on Nostr. If you're still relying solely on legacy platforms to learn about Bitcoin, you are doing yourself a disservice. Nostr is where Bitcoiners speak freely, share insights, and build in the open. There are no algorithms suppressing reach, no shadow bans, no centralized moderators deciding what is acceptable discourse. If Bitcoin is about self-sovereignty, Nostr is its social layer. Value for value. If this show provides you a signal, consider returning value. Zaps help us keep producing independent, ad-free content. Fountain.fm makes this easy. Share, discover, and support over 4 million podcasts and emerging creators, powered by Bitcoin and Nostr. Final thoughts. Bitcoin is not a trend. It is not a trade. It is not a political movement. It is a tool for saving in a world of debasement, a tool for coordination in a world of fragmentation, a tool for truth in a system built on abstraction and opacity. You do not need permission to use it. You do not need approval to hold it. You only need conviction and patience. This is Anna, signing off from the Bitcoin Street Journal podcast. See you on the next block.